Today, we're talking about a massive shift in how the world works and, what that actually means for your money. For years, the investing playbook was pretty clear, right? But what happens when the rules of the game completely change? Well, we're going to build a new framework, not for the world we used to know, but for the complex, multipolar world that's taking shape right in front of us.
This quote, it just gets right to the heart of it. If your portfolio looks the same way it did a decade ago, you might be making a huge bet against the future without even realizing it. You see, the whole era of one single dominant economic power, it's fading. We're seeing new powers, new alliances, and frankly, new rules being written. Sticking to that old playbook isn't just outdated, it's a massive bet against this new reality. All right, so before we can build a new portfolio, we've got to tear down the old one. In this first part, we're going to take a hard look at the classic safe havens. The assets people flock to when a crisis hits. But are they really as safe as we've all been led to believe? Let's find out.
Just think about it for a second. The markets are in a total free fall, panic is in the air. Where does everybody run? For almost everyone, there's one answer that just jumps to mind, isn't there? Gold.
Well, here's the brutal truth. We all think of gold as the ultimate insurance policy. The classic idea is that it's like a teeter-totter. When stocks go down, gold is supposed to go up. But what does the data actually tell us? In a real full-blown panic, people sell what they can, not necessarily what they want to, and very often that includes their gold.
So look at this number, 0.63. That was gold's correlation to the S&P 500 during a recent major downturn. Now, for it to be a perfect hedge, that number should be negative. Instead, gold actually moved in the same direction as stocks. Now, to be fair, it fell way less, so it definitely helped preserve capital, but it wasn't some magic bullet for a crash. It bent, but it for sure didn't stop the fall.
Okay, so if gold isn't the perfect shield, what about trying to profit from the fear itself? That's the logic behind using the VIX, which you might know as the market's fear index. The idea seems simple. When markets panic, the VIX skyrockets. So you just buy something that tracks it, and boom, you have a perfect hedge that zigs when the market zags, right? Well, it's not quite that simple.
This is the absolute killer when it comes to a lot of VIX-based products. Time decay. The pros call it theta. Basically, the way these funds are built means they are designed to systematically lose value over time. Holding them is literally like holding a melting ice cube. Even if you're right and a crisis is coming, if you're too early, the value of your hedge could just melt away to nothing before it ever pays off. It's an incredibly powerful tool for timing, but it's a dangerous thing to just sit on and wait with.
So, we've established that the usual lifeboats, well, they've got some holes in them. But what if we're preparing for the wrong storm entirely? What if instead of hedging against a temporary market crash, the real risk is a permanent change in the global economic weather? We're talking about the slow, steady shift away from a world run by one power to a world with many.
The data really tells the whole story here. For decades, the US dollar was just the default currency of the world. But as you can see from this chart, that's changing. Over the last 20 years, its share of global reserves has dropped from around 70% all the way down to 59%. This isn't some sudden collapse. It's a slow, unmistakable drift towards a world that's just less reliant on any single currency.
And look, this isn't just theory. You can see the new plumbing being built in real time. You've got Russia selling oil to India using other currencies. You have China and Brazil agreeing to settle their trade directly without ever even touching the US dollar. As the slide says, these aren't just one-off events. These are the actual building blocks of a new global financial system, one that's a lot more fragmented and a lot more complex. And this fracturing goes so far beyond just money. It's about the physical stuff, the actual materials that make our modern world run. The old way of doing things was all about long, efficient global supply chains, but the pandemic and recent conflicts showed just how fragile that system really is. The new reality is that countries are starting to prioritize security over pure efficiency because they realize that controlling the supply of key materials is an incredible form of power.
This comparison says everything you need to know. We used to think of steel as the ultimate strategic asset, but today, defense only makes up about 3% of US steel demand. Now think about a mineral like gallium. It's absolutely essential for every advanced microchip on the planet, and China produces 98% of the world's supply. In this new world, controlling the flow of a few critical minerals is way more powerful than controlling mountains of steel.
Okay, so we've diagnosed the problem. The old hedges are shaky, and the world itself is changing under our feet. So what's the solution? Well, in this section, we're going to look at the precision tools that the pros use, not as wild bets, but as specific, targeted insurance policies for their investments.
So the first tool in the pros toolbox is something called a protective put option. Honestly, the best way to think about this is as literal insurance for a stock you already own. It's not a bet that the market is going to crash. It's a contract that puts a hard floor under your investment, protecting it from falling past a price that you choose.
Let's just walk through a quick example. Imagine you own a stock that's trading at $50. You buy a put option that sets a floor price, let's say at $45. Now that option has a cost, just like an insurance premium. But here's the magic. If that stock plummets to $10 or even to zero, your contract gives you the legal right to sell your shares for that predetermined price of $45. You've effectively captured maximum loss. It's precise, defined protection.
All right, our next tool is the futures contract. And while these might sound super complicated, their origin is actually really down to earth. See, they weren't invented by traders on Wall Street. They were created by people who make and use real things. Farmers, miners, and factory owners who just needed a simple way to lock in prices and bring some predictability to their business.
This baker analogy makes it crystal clear. The baker's entire profit depends on the cost of flour. If that cost suddenly spikes, their business could be in serious trouble. So they use a futures contract to agree on a price for flour 1 year from now. They lock in their costs. Sure, they might miss out on savings if the price of flour drops, but what they gain is certainty. They protect their business from a catastrophic price spike. It's all about removing a known unknown from your business plan.
Okay, we've broken down the old world, we've identified the new risks, and we've looked at the professional tools. So now it's time to put it all together. How do you actually build a portfolio for this new era? Well, the strategy is to invest in the picks and shovels, the fundamental, essential things that everyone is going to need in a more competitive, fragmented world.
First up, critical minerals. Like we saw, these are the non-negotiable raw materials for everything from EVs to advanced weapons. Second, defense localization. As global tensions keep rising, countries are scrambling to build their own defense industries at home. And third, AI infrastructure. This really is the 21st century arms race. But victory isn't just about who has the smartest algorithm. It's about who controls the raw physical infrastructure, the power, the cooling, the networking that allows that AI to even exist.
And if we drill down into that AI infrastructure, the real picks and shovels aren't always the flashy chip designers. It's the companies that handle the grunt work. I mean, think about it. Thermal management to stop these massive data centers from literally melting, high-speed networking to connect them all, the construction companies that physically build them, and maybe, most important of all, the power grids that can feed their insane hunger for electricity. These are the essential physical building blocks of the entire AI future.
This table really puts the two worldviews side by side. On one hand, you've got the legacy portfolio. It was built for a stable, globalized world, and its goal was smooth, steady returns. On the other hand, you have the multipolar portfolio. It starts with a totally different assumption, that the world is defined by competition. So its primary goal isn't smoothness, it's resilience. It's designed to withstand geopolitical shocks by focusing on defense, critical resources, and secure, localized technology.
And that brings us to the one question you really should be asking about your own portfolio. Is it built for the world of yesterday, a world of cooperation? Or is it ready for the world of tomorrow, a world defined by competition? Because the answer to that question could make all the difference. Thanks for joining me.